Ladies and gentlemen, good day and welcome to Aavas Financiers Limited Q2 FY24 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this call is being recorded. I now hand the conference over to Mr. Sachinder Bhinder, Managing Director and CEO of Aavas Financiers Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. Thank you for participating in the earnings call to discuss the performance of the company for Q2 and H1 FY 2024. With me, I have Ghanshyam Rawat, President and CFO, Ashutosh Atre, President and CRO, Siddharth Srivastava, Chief Business Officer, Surendra Sihag, Chief Collection Officer, Ripudaman Bandral, Chief Credit Officer, DG Oman, Chief Technology Officer, Anshul Bhargava, Chief People Officer, Rajaram Balasubramanian, Chief Strategy Officer and Head of Analytics, Ghanshyam Gupta, Investor Relations and SGA, our IR Advisor. The results and the presentation are available on the stock exchanges as well as on our company website, and I hope everyone has had a chance to look at it. We are committed to support and strengthen the long-term Aavas Vision 3.0. I take this opportunity to thank all our stakeholders for the continued trust and support. For Q2 FY 2024, we disbursed 12,585 million, registering a 18% growth quarter-on-quarter and 10% year-on-year growth. We continue to grow in a calibrated manner, registering AUM growth of 22% as of September 2023. Further, OPEX ratio has witnessed gradual moderation from 3.79% in the last quarter to 3.65% in H1 FY 2024. While maintaining our operating metrics, we delivered a PAT of rupees 2,313 million, translating into a growth of 18% year-on-year for H1 FY 2024. While we continue to borrow judiciously, we raised around 30,761 million at 8.19% during H1 FY 2024. As of 30th September 2023, we maintained a sufficient liquidity of rupees 50,037 million in form of cash and cash equivalent and unavailed cash credit limit of rupees 20,987 million and unavailed document sanctions of rupees 29,050 million, including rupees 10,000 million from the National Housing Bank. We are undergoing an accelerated digital transformation with the adoption of best-in-class technologies like Salesforce, LOS, Oracle FlexCube, which is LMS, and Oracle Fusion ERP. We have successfully rolled out and stabilized phase 1 of Salesforce. Oracle Fusion ERP GL went live in September 2023 under hypercare. The new loan management system on the FlexCube is currently under testing and migration. I would now hand over the line to Ghanshyam Rawat, President and CFO, to discuss the financials in detail.
Thank you, Sachinderji. Good afternoon, everyone, and a warm welcome to our earnings call. As on 30th September 2023, an average borrowing cost of 7.86% against an average portfolio yield of 13.15% resulted in a spread of 5.29%. We have been able to maintain our spread above 5% despite competitive pricing pressures. As on 30th September 2023, total number of live accounts stood at 198,947, translating into 19% year-on-year growth. Total number of branch count was 350, with the 4 new branches being added in first half of FY24. Employee count was at 5731. Assets under management grew at 22.1% year-on-year to rupees 1,53,195 million as on 30th September 2023. Product-wise breakup: home loan 69.7%, other mortgage loan 30.3%. Occupation-wise breakup: salaried 40.1%, self-employed 59.9%. IGAAP to Ind AS reconciliation has been explained in detail for profit after tax and net worth on slide number 32 and 34 of the presentation. On the borrowing side, there is access of diversified and cost-effective long-term financing, very strong relationship with development financing institutions. Total outstanding borrowing as on 30 September 2023 stood at 1,40,843 million. Overall borrowing mix as of 30 September 2023 is 49.6% of term loan, 20.8% from assignment and securitization, 18.3% from National Housing Bank, and 11.4% debt capital market. Lender support continued to remain extremely strong. Liquidity of 50,037 million as of 30 September 2023. Cash and cash equivalent of rupees 19,887 million. Unavailed CC limit of rupees 1,100 million. Documented unavailed sanction limit from National Housing Bank rupees 10,000 million and other banks 19,050 million. Profitability. Profit after tax increased by 17.9 million year-on-year to rupees 2,313 million as for the H1 FY2024. ROA was 3.25% and return on equity was 13.64% for H1 FY24. As on 30 September 2023, we are very well capitalized with a net worth of rupees 35,136 million and capital adequacy ratio at 48.16%. Our book value per share stood at 4,044.1 rupees. Now, I would like to hand over the line to Ashutosh Ji, President and CRO, to discuss the assets quality.
Thank you, Ghanshyam Ji. The key portfolio risk parameters, asset quality and provisioning. One day past due stood at 3.58% in H124 as against 4.45% at the H1 of last year. Gross stage 3 stood at 1.04% and net stage 3 stood at 0.76% as of 30th of September 2023. Gross stage 3 of 1.04% include 0.13% of up to 90 DPD assets which have been categorized as GNPA following RBI notification dated 12th of November 2021. During FY22, a resolution plan was implemented for certain borrower accounts as per RBI Resolution Framework 2.4 dated 5th of May 2021. Basis the perceived risk and as a matter of prudence, some such accounts with an outstanding amount of rupees 779.6 million as on 30th of September 2023 have been classified as stage 2 and provided for as per regulatory guidelines. Out of 779.6 million, rupees 575.3 million is into 0 to 30 DPD bucket. Total ECL provisioning, including that for COVID-19 impact as well as Resolution Framework 2.4, stood at 797.3 million as of 30th September 2023. Total write-off stood at 20 million in H1 FY24. Aavas continues to maintain a pristine asset portfolio quality. With this, I open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mayank Agarwal from InCred Capital. Please go ahead.
Yeah. Thanks for the opportunity and congrats for the good set of numbers. My first question is on employee cost. So we have witnessed the low employee cost this quarter. Any specific reason for that, and what share of the reduction can be attributed to the employee count? And can you please also let us know what is the employee count this quarter? This is my first question. My second question is, if the reduction in the employee count is temporary or is something structural which is led by the technology implementation? Yeah, that's the two questions for now.
Yeah. Thanks, Mayank. On employee cost, employee count is the same what was in the first quarter or in the same quarter. And if there is some reduction in the employee cost, is mainly on account of in the last quarter there is some one-time cost was there on account of incentive bonus, and one of the senior SMP got resigned in that quarter. Apart from that, I think it's a steady state on employee cost now.
So okay, this trend would continue. Okay. And my second question is on your yield. So you have reported a 10 bps of decline this quarter. Is it due to the low rates on the new loans or reduction in the loan rate of the existing customer?
Yeah, Mayank, this right, Satinder. This is partly because of the rate reduction on holding on to our existing customer, and part is on the new placement. Both put together has resulted in the drop in the yield.
So is it because of the increasing competition intensity which we are witnessing? Because on the one hand, cost of borrowing is increasing, and we are witnessing a yield decline. And what could be the trend going forward on the margin? So basically, what would be your margin outlook, and till what we would be comfortable with keeping the excess liquidity, and what would the margin outlook for FY24?
So as we have been saying that we were able to maintain the spreads at 5% and above, so which is currently around 5.29. Our endeavor is there, but what we are trying to do is that the good customers are there. We don't want to let it go. So partly because of rate reduction on that side, and some part and some bit on the pricing pressure on the new acquisition, so to say. So it's a mix of both. So from a guided perspective, I think we will try to maintain in range of 5% as far as concerned, despite and in spite of the cost of borrowings going up. Actually, that would be our endeavor, and that's our aim actually.
Okay, thanks. I'll get back in the queue, and best of luck.
Yeah, thanks, man.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good afternoon, everyone. So first question on disbursements. In the first quarter earnings call, you had shared that large part of the teething issues were behind and things had stabilized in June. In June, disbursements had grown 17% year over year. So, but if I look at the second quarter disbursements, they are up just about 10% year over year. So what would you attribute this to? Is it that mortgages, especially lower ticket size, is going through some kind of a slowdown, or would you say that this could be the lagged impact of the withdrawal of the CLSS subsidy, or is it just the competitive landscape which is attributing to this sluggish disbursement growth? If none of these, was it again some teething issues from the digital transformation which led to lower disbursement growth?
I think, thanks, Abhijit. I think if you'll have to see that quarter on quarter we had an 18% growth, whilst we are cognizant of the fact that there was a lagged impact compared to the previous year. But I think from a perspective of this, we will be guided in that range, and on the EUM rate will continue to be in the 20 to 25% range. Secondly, on a part of there is a certain amount of lagged impact of sanctions not getting converted to disbursement. So if we were to really look at the earlier sanction to disbursement ratios, they have sequentially actually dropped from 90% to 80% actually, so to say. So there is some amount of the pickup which was there on that side, which were not got converted actually. So it is attributed to two. And secondly, on the technology transformation, we are out of the boards, but if you will be guided with the transition which is happening in the institution, a couple of quarters to really settle them out on a perfect basis, because we've got into the second phase of technology transformation, which is LMS and ERP, and we are taking this this year as full year for taking the entire completion of transformation, actually, so to say.
Got it, sir. So by the end of this year, you are suggesting this digital or technology transformation will be completed, including the LMS and the ERP.
Yeah, that's our target, actually, Abhijit.
Okay. And sir, this lagged impact that you were explaining of sanctions not getting converted to disbursements, I heard you right where you said earlier we had 90% conversion of sanctions to disbursement. Right now it's dropped to about 80%.
Yeah, right.
Got it. So secondly, again, kind of going back to the margins, if I look at your reported numbers from 3-month FY24 to 6-month FY24, you have reported margins of 8%, which are flat. So if you kind of go to your P&L, look at the net interest income line, excluding the assignment income gain, I mean, sequentially we are seeing a decline from 226 crore in the first quarter to 222 crores, 222 crores in the second quarter. What would explain that, given that, I mean, our book has grown? I mean, on a calculated basis, there is a good 40 basis points decline in margins in the quarter.
Yeah, Amit, I think as you see the number, I think we will see in detail those numbers. But largely, it is only on account of you will see quarter 1 to quarter 2, we have seen decline in the portfolio yield, which is 11-12 basis point. So which has, I think, mainly impacted on that line item. Apart from that, I think we don't see any sort of machine in there.
Got it. Sir, and one last question. There seems to be a lot of volatility in our employee expenses line. I recall we had shared even last quarter that in 1Q FY24 we had one-offs in employee expenses of almost 1.5 crores due to a KMP retiral benefit. I think before that in fourth quarter we had a reversal of 5 crores on ESOP expenses. Subsequently, we had taken an ESOP charge of 7 crores in 1Q FY24. During this quarter, I mean, from an ESOP perspective, were there any reversals? If you can quantify that. And going forward, I mean, how should we look at the employee expense line item?
Employee cost is seen in two ways. First thing, employee count is where we, as I mentioned, we are steady state, same count of employees there in the last 2 quarters. So yes, annual increments and all these things is taken place in the first quarter. So that impact comes, some of the thing impact come in the first quarter, and now second quarter come the full impact is there basically. Yes, ESOP, all these things expense depend upon the 2 factors. If any new schemes comes, then extra cost comes in from that quarter to till the scheme run basically. And if there is any sort of, let's say, attrition in the employees, so for that remaining cost also goes off from the in that quarter from the P&L side basically. So those are basically accounting principles which everybody need to follow. Apart from that, I think it's we don't have any sort of any extra explanations on the employee cost.
Got it, Ghanshyamji. Sir, in the interest of time, I just wanted to squeeze in one last question for Sachinder sir. Sir, I mean, again, going back to the disbursements, just wanted to understand today if I look at some of your listed peers, unlisted peers, right? There are listed peers, almost half your balance sheet size doing 78 to 85% of the quarterly disbursements that you are doing. I understand we've gone through some management changes, we are going through a tech transformation. By when should we expect that we'll kind of start achieving disbursements that you internally aspire for?
Thanks, Abhijit, and you rightly articulated. I think the 2 points. One, we've emphasized on the transition on the management side as well as on the tech side. I think you have to bear with us for a couple of quarters. There is a fact that building the right foundation, which will see the performance based on the current set of things, both on the tech transformation which we see and which we have embarked on the journey along with the management transition. I think give us a couple of quarters and you'll see that back in action. But I think you have to be cognizant of the fact that despite a big transformational change from a tech perspective, we've been able to weather that out compared to what the peers or others would have done in our space. So I would request a couple of quarters to bear with us for, we again would endeavor for a calibrated, muted growth, but not that we'll come back in a couple of quarters back on track on what we are there on the range. But again, we get guided on the quality of what you have to really embark on is that some of the parameters on the health side continue to be very robust on the quality parametric, on the metrics of controlling costs wherever it is possible, and from a perspective of delivering the pristine quality on the base which we are noted for. I think as a mix of both, I think we will be in a strong position to come back on the base what we have there on at this period of time.
Good, sir. This is useful. Thank you very much, and all the very best to you and your team.
Thanks, Abhijit.
Thank you. The next question is from Raghav Garg from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. One very specific question. You had a spread of 529 this quarter. Do you expect that this would decline further in the second half, or will this remain at this level?
So I think we are guided, Raghav, with the spread of keeping it around 5%. I think it's a mix of the kind of cost of borrowing, which is the one which is one input which is beyond our control. Our endeavor is to be remaining in a range bound level of around 5%. So that's been our endeavor.
Sir, I'm coming more from a place where I'm trying to understand what is the competitive intensity as far as pricing is concerned. When we look at some of the larger players, they haven't really touched on pricing. It remains as low as say till about 9 to 10 months ago. So should we expect that even in the second half, your pricing will remain impacted because of competition, and hence that is something that will weigh on your spreads?
So I think
it will be lower than 529.
So as we said that we will remain above 5%. That's what we've been guiding.
Sure. Sir, just on your securitization margin also, so in Q2 of FY23, we had a gross upfront income on the assignment of about 494 million. It's come down to 466. Why would that be the case?
Basically, it depends upon the volume of what volume you do the assignment basically, and what sort of asset you do the assignment, what yield of assets assignment. 2-3 factors determine that overall how upfronting income comes basically.
Okay, but your securitization assignment volumes have increased YOY, right?
Asset classes also make a difference. What assets pricing will be sold at that point of time, or what assets interest yield asset be sold this time basically. Both make a difference in that account.
Sure. And on the reversal of the income which was recognized earlier on the assigned pool, right? That has also increased to about 335 million. So that would probably be because some of the assumptions that you would have made earlier have not played out or have played out adversely. So can you highlight some of the nuances which would have impacted such a reversal?
Yes, that is not a major impact of reversal. Reversal is not as volume got increased. So the reversal also amount get increased every quarter basically. What assignment I have done in the let's say Q1 or let's say Q4 of the last year, so those will have a full impact of reversal in this quarter basically.
Understood, sir. Thank you, sir. My last question is on non-HL book. So that's been growing at a fairly healthy clip, 30% for last several quarters now. But we see that since last 2 quarters, the NPAs are also increasing in that book. Anything to read into this as to why the NPAs are increasing on this book?
Now I think now you see we give all the mortgage-backed loan average tenure is generally 7 to 10 years, and so now this book is we are entering the fourth year. Almost its book is coming at a steady state basis. So we see roughly gross NPA in other mortgage loan will be remain between somewhere between 1 to 1.25% around. And the home loan book will remain less than 1% around basically. So this is now almost reaching the maturity level of gross NPA in both class of book.
Understood. You're saying it's more of a normalization rather than...
Yes, with the maturity of the asset cycle basically, with the maturity of asset life.
Right. And sir, just, sorry, one last question. Your share of variable rate book has been going up. So do you think that would be a risk, in terms of, say, probably a balance transfer,
No, I think we don't see in this fashion variable or fixed. The variable or fixed books depend upon what liability we source from the market, what opportunity available on the liability side and what deployed on the asset side. What we see the opportunity asset side, accordingly we raise the liability. That is, we don't take a risk in a floating and fixed while managing our ALM.
Understood. Thank you. Sir, what was the BT out for this quarter? Can you highlight that number and compare to what was it in Q1?
So it is flattish, so it is 0.5% per month, so coming to around on a yearly basis 6%.
Sure. That was very helpful. Thanks a lot.
Thank you. The next question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. A couple of questions. Partially you did answer, but you mentioned the fact that now the systems are stabilizing and they're almost settling, and this should happen by the year end. So what is the disbursement run rate we should look forward to, especially in the light of H2 being slightly better than H1?
I think, Shweta, we've always guided on the AUM growth that we'll be in range of 20 to 25%. So I think from a perspective of quarter-on-quarter growth, you see in the quarter 2 growing on the quarter 1 at around 18%. So we'll look at a moderated, calibrated growth in the coming quarters, considering the two aspects which I talked on the call earlier. One is the management transition, and second is a big transformational change on the tech side on 3 platforms all put together actually.
Sure, that helps. And so secondly, a little bit on yields. Sorry, I might sound repetitive. So we can imply that the repricing is completely behind, right? Because you are almost on the verge of customer retention, and therefore you have opted for reduction rate. So the ability to pass on or the scope to pass on is limited from here on, and therefore spreads could remain range bound. Is that assessment correct?
Yeah, there's see at this period of time, whatever was the last pass on had happened subsequent to that, there's nothing which has increased on the PLR side. So you're right on articulating that is there a possibility of pass on? No, it is only whatever is the placement yield which is there, and some part of it which I talked about earlier on the result in 11% dip in the yield is one is on the retention side, because we've been very cognizant of the fact that we retain the good quality customers. So there it results in a drop in the yields, and some part of the competitive pressure on getting the new business. So it's a mix of both.
Okay. And so one last question. So the MSME or the non-mortgage mix, the other home loan mix. Now, if I just look at the percentage mix, more or less it has remained steady. So, and the industry is calling out for concerns in small ticket lending. So I understand you had given an explanation last quarter. So anything, any red flags, any read-throughs, what is your reading on the ground?
So, Shweta, as always, we've been there that we are in the business of cash flow-based underwriting, and all our loans are backed by either self-occupied residential mortgages or the commercial property, most of them self-occupied residential mortgages. And typically, we are not there in any way in the unsecured segment or a small ticket size loan. And we are very of the fact that we don't depend on anything which is volatile, either from an income generation perspective, which is either subsidy based, which is dependent on weather gods, or which is dependent on incomes which are volatile in nature. So this has been our basis of cash flow based underwriting on this. So we don't see at this period of time any red flags on that segment.
So just one bit there, because you mentioned that we are not subsidy based dependent. So just, with CLSS subsidy going behind, most of the affordable housing finance players have seen sluggish growth, and I understand that ours is a very small portfolio. So could you just describe how small has been our CLSS portfolio vis-a-vis competition, and of course that has not impacted anywhere on the growth prospects for Aavas, right?
So we've never been super dependent on the subsidy-based kind of schemes, and as you would really appreciate that Aavas is in unserved, underserved, unbanked, and that too on self-construction individual home loan category. And the self-construction individual home loan category was not the one which was under this segment. So when you are at 70-25% of the portfolio which is on the self-construction individual home loan, these are not impactful items actually for us to really play out.
Noted, sir. That answers. Thank you so much. Best of luck.
Thanks. Thanks, Shweta.
Thank you. The next question is from the line of Renish from ICICI. Please go ahead.
Yeah, hi, sir. So just two things. One is on the average ticket size on the disbursement level, which is at 1.3 million. So what is happening on that side? I mean, given our key focus area has always been less than 1 million ticket size, but when I look at the disbursement ticket size, it is as high as 1.3 million. So, practically it is 25-30% higher than the what we have been doing. Maybe in Q2, if you can highlight the number of, let's say, files logged in, or maybe volume growth versus the ticket size growth, sir?
It's not as such. I'll give the 2 points here basically. One, if you see my non-home loan average ticket size last year H1 to this H1 is not any change. But in home loan side, if you will observing that it started from Mumbai, then I think Delhi, then I think in Jaipur, state capitals and big towns, we are seeing the property prices also increasing. And this thing we are seeing in our ticket size last 7-8 years didn't risen at all basically. So it's basically led by inflation, led by property prices, and we have seen some increase, almost let's say 10% increase in our home loan ticket size basically. As a business model perspective, we are not seeing any change, or we are not following any change in our strategy. Continue to focus in the same market, same customer base, and similar property profiles.
Got it. And sir, secondly, again circling back to the sanction to disbursement ratio, which fell to 80% versus 90% earlier. So what are the reasons for this fall? I mean, have we tightened our credit filters, or how is it?
See, it's a two-bit. One is the kind of demand which was there, and secondly on the competitive pricing pressures which we had to let it go and let it pass by, saying at that kind of field where competition was coming in. So probably it is twofold. As I said, that as we are there in the self-construction individual home loan category, and I think certain part of India on the places we operate were impacted by incessant rains actually. So that also has stemmed the construction activity. So that was another one of the areas where it actually fell. So I think in the coming quarters we will see that picking up in the coming quarters.
Got it, sir. And just last thing from my side, broadly at the strategy level over a medium term. So when we look at, sir, at least on the listed side, players are growing at 30% plus. Our growth rate is, or maybe we want to grow at 20-25% around that number. So, within these sub-segments, we'll be losing market share for sure. I mean, when we look at or when we compare the growth. So how we internally look at it, I mean, are we okay to, let's say, lose some market share and grow our balance sheet the way we want, or maybe once the system, etc., stabilize, we again want to sort of come back to market and gain market share?
So always it has been, as we have always put out, that our guidance has been in the range of 20 to 25% AUM growth. So we would not let any opportunity pass by when it comes to once the management transition and the tech transformation is fully in place. And as we said that some of the states where we are already there would like to build and grow, wherein the EM growth would be in excess of what we talk about on an average one. Second is the second level where it would be a moderated one, and that would help us to invest into the new states where we entered. So, Ranesh, to put it in perspective, we would really capitalize the opportunity available at the stages where we find there are risk-adjusted returns and the quality and the metrics fits our steady state actually.
Okay. So, got it. So, we will not look at market share trend at all, I mean, internally.
So, we are in that segment. Probably it is, as we said that for us really to grow at our kind of metrics and our kind of things, which is 20 to 25% on the base which we are. So, you will really appreciate that we are currently 15,000 plus AUM. And on that base, with a guided 20 to 25% growth, with the kind of quality metrics which we are talking about, GNP of around 1%, 1 plus of less than 5%. I think these are the metrics which have to bear and on a long-term basis.
Got it. Okay, that is from my side, sir. Thank you.
Thanks, Ranesh.
Thank you. The next question is from the line of Sonal Gandhi from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity, sir. I just have two questions.
Sonal, your voice is very low. Request you to use the handset.
Is this better?
Yes, much better. Please go ahead.
Yeah. So I have two questions. One is if I look at your non-home loan portfolio, so the borrowings or just to put it to the disbursements over here are up by about 415 crores, and AUM is roughly up by about 408 crores on a quarter-on-quarter basis, suggesting that the repayment rate is very, very low. So can you just explain what has exactly happened over here?
Sonal, can you articulate again? Voice was wobbling and we were not able to get your question right in right frame.
Okay, if I look at your non-home loan portfolio, okay, so disbursements in this segment is up by about 415 crores on a quarter-on-quarter basis, whereas the AUM is up by about 408 crores on a quarter-on-quarter basis. So suggesting that the repayment rates are very, very low over here. So can you just explain what exactly has happened over here?
So you're referring to...
we are parking this question. I think we will come back to... if you rightly understood, you are telling that our disbursement of non-home loan is not reflecting in the AUM growth. Do you mean that?
What I'm trying to ask here is that the disbursements, basically the repayment rates are very, very low over here.
No, I don't think so. Why are you referring, Sonal, if you can be a little more specific?
We don't see any sort of, at our internal MIS and internal, I think, discussion, we are not seeing the similar repayments come from home loan and non-home loan.
Let me just share this data with Ghanshyam and, let me just share this and, we can take this offline.
Yeah, please. Send back some more detail to Ghanshyam Gupta. He will revert.
Sure. And another question that I had was on your turnaround time. So, whenever I've spoken to you in the past, we have been trying to get our TAT down from 11 days to 6 days. So which functions, in which functions do we expect, that the digitization would help us to reduce the turnaround time, whether it is underwriting or, which stage basically would help us to get down this turnaround time?
So underwriting piece would be the one, right? See, it is a multitude of all of them, right? From the starting, we have a control on what is getting built in, what is getting sourced, and the very fact that the tracking is there. So that's the first point. And secondly, earlier times also, which we highlighted, is because of this automation, because of the tech, we are able to really predict and able to convert in a reduced time frame, and that really impacts our underwriting time. And this is it is facilitating and helping. It is not doing away with what we are hardwired for hard to underwrite SENP segment actually, so to say. So this is a helping factor which reduces the turnaround time as a facilitating factor from a tech perspective.
Okay. And another question, sir, that I had was if I just calculate the volume, so you've given your average ticket size for the quarter and disbursements in home loans. So that is suggesting that there is, I mean, if I look at home loan disbursements, the ATS is up almost 19% YOY basis. And if I look at the disbursements all put in together, that is at 8%, suggesting that there is some volume decline that has happened over here. So again, is it broadly because of the competition that the volumes are going down, or how should I look at that number?
So I think the increase in the ticket size, what Ghanshyamji earlier highlighted, is because of the growth in the regions like the new states like Karnataka, Maharashtra, and some of the central region, which has reflected in the increase in the ATS value. I think that's the only factor which we see as a growth. And other than that, we don't see anything which is by any planned way or by any strategic way which has made this happen actually.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi. So just in terms of the productivity, so if we really look at it in terms of productivity per sales officer, it seems to be like less than maybe 2 files a month. So no doubt overall debt has come off, plus there has been like the increase in ticket size, but not finally reflecting in terms of disbursements per branch. So maybe what could be the ideal level of disbursements maybe per sales force which we can look at it? Because today maybe so if you can help in terms of what are the number of sales team currently, and looking at almost like say 420 odd crores of disbursements per file, disbursements in a month seems to be quite low compared to where we were historically, and how we are addressing that. Yeah.
Kunal, this gets bifurcated on the side. So Kunal, this gets bifurcated in 2 parts, and as you would really appreciate and you have the full pulse of the market, I think the attrition at the RO level stability becomes to be concerning, as a result of which there is a wobbly productivity count which actually happens. So I think steady state, it becomes very difficult to get into a predictable range of on the one. Once the stability of the front line, which is the RO is there we see an increase from 2 to 3 and 3.5. So some of the ones where you have the aging which is there is in excess of there, but the ones which you have new force which comes in takes time to really settle down and give being productive. Since we are into a direct distribution model and in the segments which we operate, which is very different from the ones where typically an intermediary driven kind of business operates. So I think as a mix of both, one is the aging of the thing would be a little higher on the average side, whereas the new ones take time, and plus the attrition at the front line. I think it's a mix of 3 which impacts the overall productivity. But I'll tell you another point from an Aavas perspective, we are very conscious of the fact, and we are trying to do measures which will really help the front line from a perspective of one is really making them on the developmental side, so they are there on a longer tenure with us, and on the developmental side when it comes to the career progression with Aavas. So we have had a special focus by our HR really to focus on these segments specifically, so to say, and that's been initiated in the previous quarter. So I think you'll see that some part of it compared to what we were there efforts, which will really translate into both the health and the performance.
Sure. But what would be the frontline sales team, maybe in terms of the number today?
So this is anything ranging
3,200.
Yeah. So that's where I was coming at. So maybe if we look at 3,200 frontline staff and around about 420 odd crores of monthly disbursement run rate, Okay, so that's coming to like 13 lakhs, which is one loan, okay, per officer. So maybe whichever cut we do, obviously I agree in terms of the new recruitments could be there. They might not be so productive, but still like that number, 1 or maybe 1.5 seems to be quite low compared to where the entire industry is, because everyone tends to target like 3 per month in terms of the disbursements, yeah, at least per sales officer.
Yeah, Kunal, that is one which is there more of an intermediary direct distribution on the kind of quality and the rate which we have. So I'll tell you, from a perspective of, I have about 15,000 worth of files which get login every month. My login to sanction ratio currently comes out at 5,000. So if you look at the login to sanction, it is a 33%. So if the guy has to disburse one file, he has to log in 3 to 4 files actually. So that's the quality which is there. So if you're looking at from a sourcing perspective, which is there, so we do about 15,000. So the same RO, probably from a logging perspective is higher, but when it comes to real quality and the type which we do, I think it makes a difference there. The drop comes actually, right? So that's reflecting in the number of logins to sanction, right? So as I talked about 15,000 to 5,000. So for him to get on to this becomes a one, and you're talking about an average. So what happens is, and the front line has a good amount of attrition which is there. So the people who are there on board in the initial months take a normal gestation time to really become active actually. So which is normally in the range of 1 month to 2.5, 3 months actually. So as a result of which it comes down.
Sure. Okay. And secondly, in terms of balance transfer, so no doubt yields were lower, but that was largely because maybe some retention being done. If you can just highlight in terms of the balance transfer which we were seeing would have been after bargaining with the relatively lower price for them. So what would have been at the gross level, and finally what you mentioned in terms of 0.5%? Okay, that would be at the net level. But is it like those numbers have gone up, and to what extent, maybe what proportion of the portfolio would we have lowered the prices for retention? Yeah.
Roughly 0.4 per month on an average basis assets we get repriced. It depends upon the various interest rate cycle where we are. But we see the recent time it is roughly 0.3, 0.4% of opening AUM per month basis would come for the reprice basically.
Okay, 0.3, 0.4 on a opening AUM. Okay, yeah. That's helpful. Yeah. Okay.
When we do reprice, we generally charge a repricing premium also from the customer, which generally take care of my first year whatever we lose on that repricing of that portfolio basically.
Okay. Then in terms of the gross, would it be fair to assume that 0.5 net, and we can just see like, okay, we have been able to retain and reprice lower for 0.4 odd %. So the request which we would have got is still like 0.9 to 1 odd %.
Yeah. Then that's a steady state in the industry basically. We are far better than industry on that count.
Yeah.
Or some of the assets which we got allowed, it is not only on account of let's say pricing. Some of the assets we got allowed also because of their demand is known demand is much higher than the property value, and competition want to take a call on those assets. So we allow these sort of assets also in our life.
Okay. Yeah. Thank you and all the best. Yeah.
Thanks for that.
The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hi, sir. Thank you for giving me an opportunity. So my question was pertaining to your point when you said that there is some price competition that that we are facing. Any color on any specific geographies where we are particularly facing this price related competition?
It is not related to any area, any competition basically. Wherever in the market where we have ourselves has seasoned out for 3 year, 4 year, 5 year completed assets which we acquired and completed 2 to 3 years with us basically. So sometimes it happens. It's nothing specific to any geography, any assets class, any market.
Got it. And on the branches front, wanted to understand what is, when do we consider a branch as mature branch from the size perspective, and what percentage of our branches are mature for us?
I think it's because home loan penetration rural semi-urban market is very low. So it's difficult to say what is the maturity level, because we believe in those markets we have a huge runway. From today also for next 10 years we can grow those markets, those geography, 20% CAGR growth in those markets basically. So because once we start the market, then again we continuously approach to first we approach to 30 kilometers, then we approach to up to 50 kilometers in that market. So I think we don't see profitability break-even perspective. Generally, it takes 3 to 6 months in a smaller market. In the bigger market, it takes 6 to 9 months for break-even perspective. That we can say.
3 to 6 and 6 to 9.
Yeah, for break-even perspective.
Got it. And the last question was pertaining to the other OPEX. So the other OPEX was up 25% sequentially, while you have given us a lot of clarification on the employee OPEX. What led to this significant increase in other OPEX on Q-on-Q basis?
I think it's a normal, nothing as such any specific reason for that thing basically. I think AUM and book is also growing 20-25% CAGR growth, they are growing accordingly. Other OPEX, certain branch infra, certain, as we mentioned, IT and analytics, we are doing a lot of investment toward that side basically for future growth perspective. So some of the costs also coming in on that account.
Okay. As we've added 4 branches in first half, so second half we should be adding another 15 branches as per the guidance. That's right for this?
Yeah, second H2 we will add around 20-25 branches more in the H2.
Okay. Got it, sir. Thank you so much, and good luck for the next quarter.
Thank you.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Yeah, hi. Thanks for taking my question. Just one on the liability side. What would be your book cost of funding as on September 30th?
Pardon? Oh, what
would be the outstanding cost of borrowings as on September 30th?
Now, what we have declared in investor deck, which is a 7.86 is exactly the same. If you my outstanding liability multiply with the rate of interest on that day, it is some product on that day.
Okay. And so incrementally you're borrowing at 8.2. So, should we sort of assume that your cost of funding kind of inches up by maybe at a 30 basis points from here?
Not exactly. There's a 2-3 strategies playing around that, let's say, on borrowing side in another 6-month round. We, as I mentioned earlier, we got 1,000 crore rupee National Housing Bank sanctions. That money is available for next 2 to 3 quarters. In this quarter, we didn't borrow any money from the National Housing Bank. So that will help us in the next 2 to 3 quarters to contain our. It's a mixed bag of, let's say, bank borrowing, then NHB, then other market. We are targeting one of the development financial institutions in the second half that will also come at a slightly cheaper rate. Then we put one more strategy in this, I think, more specifically the quarter 2, which will be replicated in the quarter 3, quarter 4 also. We have borrowed certain money and the pass-through certificate, which is 100%, let's say, ALM match borrowing basically, and which is coming almost 40 to 50 basis points cheaper than normal bank borrowing.
Mm-hmm.
So all 3-4 strategies we are put up we discuss in detail in ALCO and put up in practice in this quarter, and we will replicate the same for next 2 to 3 quarters. And so we think on an average, let's say next 2 quarters, fresh borrowing should be, incremental borrowing should be around somewhere 8 to 8.1%.
So we probably convert somewhere, I mean, whatever, a little bit higher from the current levels is what one can say.
Yeah, obviously. Current, it will be higher than the current level.
Sure. And have you experimented with co-lending?
Yeah, we have a signed agreement with the one or two banks. We are in the process, but we didn't see much value creation in overall value system.
Sure, perfect. Got it. And just one question to Sachin there was, if your sanction to disbursement ratio kind of normalizes to what we have seen in the previous quarters, what kind of a disbursement growth would that imply?
Nitin, from that perspective, I think we should improve from the current levels. But as I said earlier also, I think two factors. One is the tech transformations and second is the management transition which are there. I think keeping this in mind, I think our conscious effort in the couple of quarters would be to really calibrate and grow quarter on quarter. And but we are committed to the AUM growth of 20 to 25% in these quarters, actually, so to say.
Okay, sure, great. Thank you and all the best.
Thanks, Nitin.
Thank you. The next question is from the line of Sanket from DAM. Please go ahead. Sanket, you may go ahead with the question. There seems to be no response from the line of Sanket. We'll move to the next question. The next question is from the line of Pallavi Deshpande from Sameeksha Capital. Please go ahead.
Yes, I just wanted to understand, I think you mentioned about the better quality customers. So have we seen an uptake in our LTV numbers anywhere else where we can capture that?
Sorry, what you said? LTV?
LTV, loan to value. Have we seen an uptick, any uptick in that? Because you mentioned about wanting to keep the better quality customers, keeping those and that in mind.
I don't know the conventional parameters on which we have drawn upon. So there's nothing which is inching up the LTVs actually, so to say.
Yeah. What Sachin will say apart from that, historically, I think as Aavas is selective in underwriting and taking a very calculated risk-adjusted price. Under that, we want to say that around 14 to 15,000 IMD base we source the file to be able to give output of 4,500, 5,000 files basically. So that's our selection ratio remains. So under that, due to that, it looks per RO base disbursement is low, but number of files you bring in the system is roughly 4 to 5 files you bring in the system every month.
Just to add on, the H124 LTV ratio was at around 54.8. It's the same as like what H1 around 54.2. So there's hardly any movement on that front actually.
Right. Second was on this, you said about the targeting the development financial institutions. So what kind of any requirements that you need to meet for getting the sanction from that side, and what's the kind of cost of borrowing you would expect then?
We have already very existing long and strong relationship with the Asian Development Bank, International Finance Corporation, CDC. I think 5-6 rounds of funding we already taken in last 5-6 years. So it will be definitely cheaper than what we borrow locally from domestic banks at 1 year MCLR. But it also adds a lot of value in the systems also basically.
Yes. And what kind of, generally as a percentage of your total borrowing, what is the kind you target?
Roughly we are 15% on development financial institutions, and as we grow, we will maintain 10 to 15% from development financial institutions.
You don't see that growing beyond, because as you've grown in size, you don't see that increasing?
I think, but then we will explore some other market also basically. Now we are AA rated entity. We think another 12 to 18 months rating upgrade may happen so that then we can raise more money from domestic large insurance companies, provident fund, retirement funds basically. So there another opportunity will be there to raise a more fund. Recently we raised the pass-through certificate. PTC is again coming a preferred route, which is more competitive priced.
Right, sir. Thank you, sir.
Thank you very much. We'll take that as the last question. I would now like to hand the conference over to Mr. Sachin Ravinder, MD and CEO of the company, for closing comments.
Ladies and gentlemen, as we conclude today's earnings call, I would like to express my heartfelt gratitude to each one of you for your participation and engagement. The dedication and commitment of our team, the trust and support of our stakeholders, and the loyalty of our valued customers have been instrumental in our growth story. Looking ahead, I want to emphasize that we will continue to maintain our sharp focus on governance, asset quality, profitability, growth, leveraging technology and creating a superior customer experience. We remain optimistic about the future and are confident that our strategic initiatives will continue to drive sustainable growth and shareholder value. Once again, thank you for ongoing support and belief in our vision. If you have any further questions or require additional information, please feel free to reach out to our investor relations team. Thank you and have a wonderful week ahead, and wish you a very happy and prosperous Diwali and festivities ahead. Thanks. God bless.
Thank you very much. On behalf of Aavas Financiers Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.
Thank you.